Breaking news. Dow plummets 4,000 points in pre-market trading, global markets frozen. Banking giant Megacorp halts withdrawals. Imagine waking up to that, not on your phone, but blared from a siren outside your window. You try to check your bank account, but the app just won't load. The ATM? Out of service, with a line of frantic people. This isn't a disaster movie. It's a plausible outcome of a system so reckless it makes Vegas look tame. This is the world of derivatives. The bomb that's been ticking since 2008 is now glowing red. You might think you're safe because you don't own derivatives. Think again. Your money, your pension, your mortgage, they're all tied to this clown car driven by bankers playing chicken with a freight train. The system wasn't fixed after the last crash, it just got a new paint job and even worse brakes. The silence you hear? It's the calm before the storm. The next crash won't start with a housing bubble. It'll start quietly, with a single obscure bet gone wrong. One failed derivative can crack the entire global financial system before the news even breaks. We're on the edge of a financial event that could make 2008 look like a fender bender. And the worst part? We saw it coming and did almost nothing. So buckle up. Tonight we pull back the curtain on the world's biggest, most dangerous casino. We're talking about a $600 trillion time bomb ticking under our feet. This isn't just about numbers, it's about whether your money will be there tomorrow. And, spoiler, the answer is a deeply unsettling maybe. Let's break it down. What is a derivative? It's a contract, a bet, whose value comes from something else. You and a friend bet on a football game. That bet is a derivative. In the real world, a farmer might lock in a price for corn with a cereal company. That contract is a derivative. Insurance against price swings. In this form, derivatives are useful. They manage risk, but Wall Street took this simple idea and turned it into a global poker game. They started making bets on other people's bets, and then, bets on those bets. Imagine a stadium where everyone's betting on everyone else's bets, all balanced on one football game. The total value of those bets can dwarf the original wager, and it doesn't stop at corner gold. Derivatives can be based on anything. Stocks, interest rates, even the weather. Yes, bankers have bet billions on whether it'll be sunny in Ohio. When you can bet on anything, the market stops being about managing risk and becomes pure speculation. The result? A mountain of interconnected bets, all ready to topple if one thing goes wrong. The wholesome insurance tool becomes a weapon of mass financial destruction. Most people don't realize you don't have to own the thing to bet on it. You can bet on your neighbor's house burning down and buy as much insurance as you want. This creates a system where risk is multiplied, not managed. The more complex the bets, the more fragile the system. And, when the music stops, everyone scrambles for a chair. That's the danger of derivatives. It's not just a bet, it's a chain reaction waiting to happen. And we're all tied to it, whether we know it or not. How big is this market? Try $600 trillion. The world's total economic output is about $100 trillion. The derivatives market is 6 times that. It's a ghost economy, a shadow web of bets floating above the real world. Picture the global economy as a one-story house. Banks have built a 60-story, rickety skyscraper of playing cards on top. That's the derivatives market. It looks impressive, but it's not real. It produces nothing. Its weight strains the foundation of the real economy. Most of this is notional value, the total amount at stake in all these bets. Banks say the real risk is smaller, but the notional value is what links everyone together. If one major player can't pay, it triggers a chain reaction. The web is so tangled, no one knows who owes what to whom. Most trades are private, over-the-counter deals, opaque and unregulated. When crisis hits, no one knows how deep the rot goes until it's too late. The lights go out, and we discover the whole system was wired to one faulty switch. That's the terror of a $600 trillion market operating in the dark. And we're all living in the house below. Sound familiar? We've seen this before. The 2008 financial crisis was a derivatives crisis. It started with subprime mortgages, bad loans bundled into safe investments. Ratings agencies stamped them AAA, but they were garbage. Then came the real danger. Credit default swaps, or CDS, insurance policies on those mortgage bundles. Anyone could buy a CDS, even if they didn't own the mortgage. You could bet on your neighbor's house burning down. For every 100 million in mortgages, there were billions in CDS bets. When the housing market collapsed, everyone wanted their insurance payout. AIG, the biggest seller, hadn't set aside money to pay. Suddenly, the whole system was on the brink. Lehman Brothers went bankrupt. Panic spread. The promises, holding the system together, were worthless. AIG was on the hook for impossible sums. If it failed, every major bank would fall. The government bailed out AIG, not to save AIG, but to save the global system from a derivatives-fueled collapse. It was a $182 billion warning shot. We glimpsed the abyss, and barely pulled back. But the lesson wasn't learned. The system survived, but the bomb was never defused. The same risks are still there, just bigger and more complex. The next time, we might not be so lucky. The dress rehearsal is over. The real show is about to begin. After 2008, you'd think we'd fix the system. We didn't. The derivatives market is even bigger now, over $600 trillion. Dodd-Frank was supposed to bring transparency, but loopholes and lobbying gutted it. Many risky derivatives still trade in the shadows. Banks invented even more complex products. Derivatives of derivatives, now tied to shaky corporate debt. The bubble has shifted, not shrunk. Regulations have weakened, and political will has faded. The banks are bigger, the risks are bigger, and the lessons of 2008 were ignored. We're like a heart attack survivor who switched from double cheeseburgers to triple. The next crisis isn't a matter of if, but when. And this time, the bomb is even bigger. Let's talk leverage, using borrowed money to make bigger bets. In derivatives, leverage is off the charts. With $1 million, a bank can control 100 million in bets. Great if you win, catastrophic if you lose. A tiny loss can wipe you out completely. Now scale that up. Banks, with $1 trillion in capital, control $50 trillion in derivatives. Their existence balances on a knife's edge. A small market move can create a black hole of losses. This isn't investing. It's institutionalized gambling. Imagine the global banking system as Barry, who has $100 but has made $5,000 in bets. As long as Barry wins more than he loses, he's fine. But one big loss, and he can't pay. The people counting on Barry's payments can't pay their debts. And the failure cascades. The whole town's economy freezes. That's how the derivatives market works. All the banks are Barry, over-leveraged, interconnected, and one shock away from collapse. The system depends on everyone winning just enough to keep the game going. But if the wrong bet goes bad, the whole structure falls. The house of cards is built on a volcano, and the ground is starting to shake. The risk isn't just theoretical, it's built into the system. When the eruption comes, there's nowhere to hide. The only question is when, and who gets buried first. The scariest part of derivatives? Interconnectedness. In a healthy system, one bank's failure is contained. Not here. Thanks to derivatives, the world's biggest banks are chained together. If one falls, they all fall. Systemic risk. Every derivative has two sides. If your counterparty can't pay, your win is worthless. The failure spreads like a virus, balance sheet to balance sheet, in hours. It's a circular firing squad, everyone insuring each other's risks. That's why AIG couldn't be allowed to fail in 2008. Today, the chains are even tighter. One failure now would spread faster and hit harder than ever before. Who runs this casino? Just a handful of mega banks. In the US, 4 or 5 banks hold over 90% of all derivatives. JP Morgan, Citigroup, Goldman Sachs, Bank of America. Their derivative exposure dwarfs the US economy. These banks are too big to fail, and they know it. If their bets pay off, they profit. If not, taxpayers bail them out. It's a heads-I-win, tails-you-lose system that encourages reckless risk. These institutions are so complex, even their CEOs may not understand the risks. Regulators can't keep up. We've created banks too big to fail, too big to jail, and too complex to regulate. And we've handed them the fate of the global economy. Here we are, November 2025, standing on the same cliff as 2008, only higher. The core problem, an opaque, over-leveraged derivatives market, remains. Dodd-Frank's reforms have been gutted. The casino is open, and the bets are bigger. The illusion of safety is the most dangerous part. Capital requirements are still tiny compared to the risks. We've institutionalized recklessness and called it prudence. The next crash could be triggered by anything: a corporate collapse, a spike in interest rates, a geopolitical shock. The system is so tightly wound it only takes a small shove to topple everything. In 2008, governments could bail out the system. Now debts are higher and political will is gone. If the biggest banks fail, we face a full system reset, a freeze of global finance. The ATMs go dark for good. We're sleepwalking toward disaster, armed with nothing but hollow promises. Good luck. We're going to need it.